Hello, everyone. Welcome back. It's Thomas here from S&B Trading. We're going to jump into exactly what went down today on the stock market. Today we had a bit of a rough, tumultuous kind of day, a little bumpy up and down. We had the Nasdaq close about 0.5% up, S&P about 0.75% green. So solid day for the bulls all in all, but there was a lot of movement today, lots of big swings up and down. I think it's one of those days where market makers are just like, we're going to cook everyone's puts and everyone's calls, and dumb money is going to get roasted. And we're going to talk about that. But first things first, we're going to talk about the big news that came out today. So like I've been talking about recently a lot, labor market, extremely tight. And I feel like now that is the new focus for the Fed. They are not really they are obviously focused on inflation and all that, or a new focus for the market, I should say, because that is really what the Fed is trying to pound into our little monkey brains, is that we are in a situation where the labor market is just so insanely tight. The jobs are just skyrocketing, openings skyrocketing, wage growth skyrocketing, nominal wage growth, very robust wage growth. And they mean by that wage growth across the board. And what does wage growth mean? Well, it means inflation. I know it sounds good for us middle class folks, but unfortunately, the Fed, they know that means when us little middle class peasants have more money, we keep spending. And when we keep spending, they keep raising prices, and then we get inflation. So that is the root cause of the situation. Not, of course, the tens of trillions of dollars that they printed. Oh, no. That's not why we have inflation. No. It's because us little peasants in the middle class keep getting more money. Rigged game, right? But anyways, job openings. 10.5 million in November. That's a lot. That's 10.5 million jobs open right now in the U.S. over the month of November. Just think about that. Think about how many people are in the workforce. That is so crazy. I mean, how many people are actually looking for jobs right now? I feel like it's about half of that. There are so many job openings. It's absurd. It's just crazy. And you got to think about that. Why are there so many job openings? Because so many businesses are still expanding, because the economy is running so red hot still. It still is. And that is what the Fed is trying to stop. Like they've said many times, that's where inflation starts, is when the economy is too red hot, when everything's expanding too much. And that's why you see so many jobs out there. And of course, because there are a lot of people that are just no longer participating in the workforce. Lots of people retired over COVID. They got their big fat raise. They got their big fat pension. They retired over COVID. They lost their job over COVID. Thought, hey, I might as well just retire. And the economy still hasn't recovered from that. So that's why labor is still, the supply and demand in the labor market is still so imbalanced. There's so much demand, but so little supply. And that is an inflationary enigma, I guess. It's an inflationary climate when you have so many jobs opening and so few people to take them. How are they going to get more people to apply to their job, to take their job? Well, they got to pay more. And I can go through all that. Yep, that's inflationary. Sorry, hate to say it. But anyways, they were expecting about 10 million total job openings. So that was about 5% higher than they were expecting. So like a red hot, like it is crazy. They have been jacking rates up so high, so fast, and the labor market just hasn't even flinched. It is crazy. So it remains on fire. Flames may have receded a bit from the highs of the initial reopening of the economy, but demand for workers remains robust, and workers are seizing new opportunities. So we still know people are still, they'll leave their job, go to another job, get a raise. That's still happening. It's still inflationary. Job hiring inched down to 6 million in November from 6.11 million. So yeah, a little bit. Layoffs fell to 1.35 million from 1.45 million. And the number of people who have quitting their jobs increased. So it's not over. The Great Resignation. That's kind of what they're saying. It's still not over. People are still job hopping. They're still leaving where they work now, going somewhere else and getting a raise, because that is the means of getting a raise now. It's kind of common knowledge at this point. It's no longer you just stay at the same company. I mean, the death of the pension fund really killed that. The pensions in America are a joke. They are not as prevalent as they used to be. So the incentive of just staying somewhere and getting your little 3% yearly, 5% yearly raise, that's no longer. Now it's you get a job, you work there for 2 years, you apply to another place, and you get hired, and all of a sudden you're making 30% more than you are than the previous job, and that's just still happening. Still inflationary. I know it sucks. It sounds great. It's great us middle class people get more money like that, but it causes inflation. I hate to say it. So Jolt's report likely won't spur dramatic change in the course of the Fed. Yada yada yada. So really, what does this all boil down to? It just tells us, yeah, labor market just isn't even moving. It hasn't flinched, man. It's crazy. I mean, it's just crazy. Let's look at the unemployment rate. Unrate. Yeah, look at that. It's just still flat. It's flat. I mean, here's COVID. It skyrocketed 14%. And since then, it's just been dropping. And we saw it dropping. We see inflation start to rise around this point. And now we are just still here. We're still right here. It's been like this all year at about 0.75%. And it's fluctuated very slightly. But it's all-time lows. I mean, let's zoom all the way out. It's basically all-time lows in unemployment, except for the post-World War II. The raging 50s, the roaring 50s. Everyone was crazy. The economy was bustling back here. You had unemployment at like 2.5%. But this is just a super duper low unemployment rate. I mean, if you look at 2007, pre-Great Financial Disaster, pre-Great Recession, unemployment was sitting at like 4.3%. I mean, it was almost like a full percent higher than it is right now. And just imagine if unemployment shot up to that right now, it would be chaos. It would be such a different economy right now. And even like back in the 90s, I mean, back before the 2000 bubble, we had unemployment even a little higher than it is right now. So this is like the lowest unemployment has been since like 1968. And of course, we all know what happened after that. Inflation started kicking up. It starts kicking up right there. That's right where inflation starts to kick up. And then they couldn't get rid of that inflation for about 2 decades. They had about 2 decades where they were battling this damn inflation. So that's kind of the grand scheme. It's weird because everyone sees low unemployment. They think that's fantastic, but it is fantastic until inflation comes shaking its ugly head. So let's jump into the Fed minutes. So today our Fed minutes were released, FOMC minutes. The minutes are basically just their little summary of the meeting that they had last December. And I just wanted to kind of go through it and get a little general like the gist of what they were trying to talk about. And they were really talking about, so they actually did say at one point that they might keep raising rates more than they previously anticipated. They've said this every goddamn FOMC meeting. They say this. They come out and they say, hey, we think this would be as high as we got to go. And then minutes come out and they're like, the members are actually thinking we might need to go higher than we previously thought. They keep doing that because why do they keep doing that? Because unemployment just isn't moving. Nothing's moving. The economy is still red hot. Still. I know earnings for tech companies and earnings for other companies are going down a little bit, but the labor market being the way it is, they can't just drop rates. So they kind of talked about market sentiment, how they saw that market sentiment was also going too high, too fast, because of course, if stocks next year, or this year, I should say, if stocks just skyrocket and we get like a 20% return on the S&P, that's inflationary. Of course, that's super inflationary. That's wealth effect. That's going to be people who are like, well, gee, my 401k had a great year. I can go buy a boat. Gee whiz, my little fund, my Facebook stock and Tesla stock went back up, so I can maybe go on another couple vacations this year. You know, that kind of thing. So they're talking about how they're completely aware. I know people act like they don't look at the stock market. It's like they absolutely look at the stock market. It is a huge wealth-changing device that they can very easily manipulate, especially make it go down. If we knew anything from last year, it's that they can control that sumbitch. So they talked about that a little bit, but really what they talked about was the labor market. So participants cited the possibility that price pressures could, let's zoom in here so you guys can actually see that. Cited the possibility that price pressures could prove to be more persistent than anticipated due to, for example, the labor market staying tight for longer than anticipated. Participants saw a number of uncertainties surrounding the outlook of inflation stemming from factors abroad, such as China's relaxation of its zero COVID policies, Russia's continuing war against Ukraine, the effects of synchronous policy firming by major central banks. A number of participants judged that the risks to the outlook for economic activity were weighted to the downside. They noted that sources of such risks include the potential for more persistent inflation, inducing more restrictive policy responses, the prospect of unexpected negative shocks tipping the economy into a recession in an environment of subdued growth, and the possibility of households and businesses' concerns about the outlook restraining their spending sufficiently to reduce aggregate output. So yeah, they're just like, yep, we can cause that recession. Maybe something bad will happen. We don't know, but they're so confident that something's not going to break because the labor market is still so tight. Like that's the thing. We're just not in a recession. The labor market is always what suffers in every recession. So that's why this one's so weird. And they know that. And they just know that. It's like they're sitting there just like, how high do we have to jack up rates until people start losing jobs? Until not really even people stop losing jobs, but how do we make it so that there isn't so many job openings? And that would be a climate where businesses start to cut jobs. They start to stop hiring. That's disinflationary. That's good. They want to see that. Let's look up labor market, see if there's any more other big words about labor market here. Yeah, they said it eased some in November, but remained quite high. Yeah, what the hell? What am I looking at? Under an appropriately restrictive path of monetary policy, participants expected labor market supply and demand to come into better balance over time, easing upward pressures on nominal wages and prices. That is really what they're looking at. Big time, big time, big time. They also remarked that this component of inflation is tended to be closely linked to nominal wage growth and therefore would likely remain persistently elevated if the labor market remained very tight. See that? They're talking about PCE price inflation. So participants noted that in latest inflation data, the pace of increase for prices of core services, excluding shelter, which represents the largest component of core PCE price inflation, was high. They also remarked that this component of inflation has tended to be closely linked to nominal wage growth and therefore would likely remain persistently elevated if the labor market remained very tight. God, I'm having a tough time reading today. So that is, yeah, that's what we're looking at. I mean, I don't know how many times I gotta say it, but the focus has shifted now. It's not, oh shoot, I hope CPI is lower. It's now, gee, I hope people start losing their jobs. I mean, and that's kind of what the market is looking at. And we got that bad news this morning that job openings are still going up. And then we get this where the Fed is like, yeah, we're probably going to have to keep rates higher than we thought, maybe raise them higher than we thought for longer than we thought. And the labor market is not even it's just not moving. So that's kind of where we're at. And now let's talk about what happened in the stock market, the fun part. All right, so today, let's see if I can zoom in here. So today, the S&P 500, we had a bit of a chop fest of a day, I tell you what. Not really choppy, just extreme swings. We gapped up today a little bit. We gap up, sell down, rip up, and look, this is why you got to watch these videos I make every goddamn day. I'm telling you all, this is where the market keeps rejecting. Sure enough, where do we reject? We run up to that trend line. Look at this bear flag we're in. Look at that. See, I thought it was down here. Earlier, I thought this flag was down here. See that? I thought so. I thought we were in this flag. Then we broke out. Oh, shoot. But then you raise this up. See, that's what these channels tend to do. They tend to extend themselves. So you might have thought this was the real channel, and I thought it was too. But we know channels just tend to extend themselves. And now, look at that. And look right. It tapped right off that trend line. Boom. Perfect. So we know sellers still waiting up there. We still have sellers up above 386. But we're still in that box. We're still in this consolidation box. How many days is that now? What is that? 13? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Yeah. Oh my goodness. We're just not leaving this box. And on the daily, we put in a big doji. So just super duper uncertainty. I mean, uncertainty to the max right now. This was high volume, I mean, it was a green day, so nice, strong buying volume, but we're still just in this bear flag. I mean, things are still just consolidating, so I can't really give you any good, like, where do we go from here? My opinions are kind of unchanged, except for this FOMC minutes and the JOLTS report that came out. That kind of confirms that I think things are still going to go down. So yeah, we're still in this, and we're just bouncing off this point of control. You can see this red line, see the point of control. We tested it, and now we closed slightly above it. But yeah, that's the S&P 500. Looking at the Nasdaq, interestingly enough, you would think tech is ready to frickin' bounce, but today it didn't do much. Today we had a weird day for tech. And look what I told y'all. Look kind of what I told you guys would happen. I drew this little arrow. I said, hey, we're probably going to run up here and reject and then come down. And sure enough, we did. But we still ended up closing on a big green dingus. And so we had a super choppy day on the Nasdaq. I mean, it had a nice range, but just chop, 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 chop. We sold off after the FOMC minutes came out. Big old sell-off here at 11. We come up, we sell off again, then we recover it all again, then we sell completely off again, and then we go back. It was just like, look at this big W. Like, Jesus, dude. Holy moly. So this could be one of those typical cases where the day that we get the news is relatively just volatile, but not really up or down. It's just kind of indecisive. And then the next day is when the market finally digests everything, and then we get the dump, and we get a big gap down, big dump, and we get the gap down, and it just keeps going down. So that's kind of what I'm looking at tomorrow. Let's look at NVIDIA. So I'm going to play right now on NVIDIA. I've been telling you guys about NVIDIA to the downside for a while. I think a lot of people are talking about NVIDIA to the downside. Let's see. Let me clean up my chart here. Sorry about this. My room is such a mess. I'm so embarrassed. So looking at the 4-hour chart on NVIDIA, we just have a super duper clean bear flag. Wow, that's easy. Holy moly, look at that. Beautiful bear flag on NVIDIA. NVIDIA was pretty strong today relative to the market. I took a put, and I'm kind of in the red right now. I saw this big red candle, so I was looking at NVIDIA all day. I'm like, FOMC puts, this kind of looks like a little bit of a rising sort of wedge kind of thing here. We're in a channel. I was like, all right, if we break these lows right here, I'm going to grab a put. And sure enough, what happens? We break the lows. I grab a put on this red candle. And then what happens? Classic, I'm dumb money. I know I'm dumb money, but sometimes I just can't help myself. This was classic. They yank it down for a second, liquidity grab, and then boom, 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 boom. Just freaking 7 green candles in a row, straight to its high of day, damn near. And then we sell off again, so I'm thinking, hey, I'm looking good, and then we run back up. So NVIDIA had a bit of a nightmare of a day. It was pretty strong compared to the rest of the market, but I'm holding the put. I think I'm in a 135 put for January 16. So a bit of a leap, a bit out of the money. But this bear flag on NVIDIA is looking good. The fact that we just cannot, I mean, we can't get above this. Look at this. We just can't get above this zone right here. Every time we get up here, we just sell, sell, sell. So we just know sellers are still up there, and they're aggressive. So every time we come up here, we just sell, sell, sell. But right now, NVIDIA, I think it has a nice looking setup. I would see a measured move to the downside on NVIDIA. Perhaps we come down, fill the rest of this gap, and then we go lower, maybe to 130 in about a week's time on NVIDIA, all depending on if the rest of the market agrees with that. But it is not like a super high conviction, like short NVIDIA right now. That's what I was saying up here. This was high conviction. This was me being like, yeah, I think NVIDIA is definitely going down. I think the risk to reward is still really good on this. The risk for me is basically up here. If we clear 150, then I'm out. I'm taking my loss. It's going to be about a $100 loss. But my target to the downside is like these lows, 138. So risk to reward, I would say, is pretty good on that. Risk to reward. See that? Pretty nice. Pretty nice risk to reward, I would say. All right, I'm actually right there. So that's what I'm looking at on NVIDIA. Bias to the downside right now on NVIDIA. I just think semis, I've given my thesis on semis for this next quarter. I think it's going to be a rough go of things for semiconductors. But let's check out Apple. What did Apple do today? Apple had a weird day today. Apple was very, very green to open up the day. And then we kind of just, we dumped hard on Apple. And we ended up closing like basically where we opened on Apple. So Apple has really been selling off hard recently, and I mean hard. It is coming down, 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 and it's very interesting that it just could not hold these gains. And now, mind you, I gotta talk about again how this is the new year. These first couple days, maybe 3 days in the market, lots of new money coming into the market, lots of bullish sentiment just by default. Every new year this happens. Let's actually look. Let's take a look at New Year's, see what happens on the new year. So this is a new year from last year. Obviously a complete nightmare. But the first day was a nice little green day. Second day, nice little green day. We ran up a little bit. And then we got the FOMC minutes where they were talking about, oh, we're going to have to start rate hikes. And that was that first, January 5th, those FOMC minutes came out. And that was the first sign of, oh, shit, it's time. They're jacking up rates. Inflation's getting bad. And that's when the market sold off 2%. And that's when it all began. But if we look at the year prior to that, I think we might have had some green. Of course, that's a red day. Yeah, look at that. First week of the year. Just a nice green week. Where'd it go? Nice little green week for the first week of the year. Isn't that nice? Yeah, we went up about 2% on the S&P back then. That was a solid gain. But yeah, anyways, that's not really a very important part of this entire thing, but it is worth mentioning that usually New Year, lots of money coming in. It's usually very easy for the market to move up during the new year. No one opens a new year and is like, all right, I'm going to short everything after a year of the Nasdaq going down 35% and the S&P going down like 20%. No one's like, hey, time to short stuff. Like, people are happy to short up here because, yeah, it's like, look at this stock market bubble. It's the biggest bubble ever. I will gladly short up here. But now we're downtrodden. We're down bad. People ain't jumping in the short, but it's still, we just cannot get like a solid day. We can't break out of this range. And that's, I can't say it enough. We're still just in this range. We're in a bear flag down here in this range. You got to break above 387 on the S&P 500. And that's really all there is to it. If we look at VIX, VIX had a sideways day, or it was down like 4%. Yeah, VIX has just been weird, man. VIX just will not go up. It's very strange. Super weird what VIX is doing. If you look at bonds, bonds were slightly up today. Or wait, I don't believe that's true. No, bonds were down today. They were down about 2.5%. Not bad. Bonds coming down a little bit. The dollar index, I believe, came down some. So, oil, I think it came down. Oh, my God. Whoa, oil dumped today. Whoo-wee. Damn, look at that. Oil coming down, boy. Not bad. Holy moly. Wow, but Exxon was still green today? Interesting. Yeah, somehow the oil stocks are green when oil dumped. All right, well, that's all I got for you guys. I appreciate y'all for watching. Let's see what NVIDIA does tomorrow. That's my favorite play right now is NVIDIA to the downside. But I do have some upside plays I'm looking at. I'm not going to share any of them in this video because I'm not 100% certain about them. But we shall see. I'm thinking downside. Let me know what you guys think in the comments. Hit the sub button. Hit the bell. Never want to miss one of these uploads, man. Come on, are you kidding me? But I appreciate y'all for watching. I'll see you later.